Welcome to this episode number 18 of Your Next Trade called Today Dollar Time. So this week we had a risk on, a lot of squeeze, a lot of hedge funds that have been panicking, closing position and suffering. So this year has been so far quite epic. We started the year very bearish and now we are up 10% for most stock indexes. So very strong year so far. But underlying is a lot of dislocation, a lot of pain on Thursday and Friday with some extreme moves. So let's look at the year-to-date asset performances first, looking at how the different indexes have been doing so far. As you can see, most developed markets, we are talking the S&P up 7.7%, Nasdaq up 15%, Europe is doing very well with the Euro stocks up 12%, Shanghai doing well, MSCI World up 8.4. So risk on the other end of the spectrum, the FX, so not much happening so far. So the dollar is pretty flattish versus most currencies. And as we're going to see during this week is very much that the dollar has been turning a bit. So the dollar was weak until Thursday and started to turn on Thursday. So that could be really something to be watching for the next few weeks. Currencies, and after that, looking at the Bitcoins and Ethereum up 40%. So really risk on. Where Ethereum, crypto, and a lot of stocks that have been struggling, to say the least, and down 70-80% in 2022, have been doing very well so far. So the bad quality assets are really outperforming. That is really what has been the overall picture. If you look at the commodities, WTI not really. Really struggling between 72 and 82, so that is the same picture. The copper up 6.5%, and then we got natural gas down for the two. So what about the week-to-date asset performances? So very strong week, 1.6% for the S&P, 3.3% on the Nasdaq, but actually after the kind of a small reversal on Friday on the S&P and the Nasdaq, that's not giving you the overall picture, where after the FOMC meeting from 7:30 UK time, we had a really strong rally across indexes. Picture interesting. I think this is really the one to be looking at in terms of the next drivers or next catalyst is the US dollar. So US dollar is up 1% on the week. So normally what you will have had so far is each time the dollar was weakening, any other assets will have been very strong, stocks, and that is not the case for this week. So that gives you a change in the underlying market despite the trend and the dislocation that we had this week. Similar here, if you look at the gold, if you look at WTI, if you look at copper, so obviously with the US dollar that is not helping, but that tells you as well that the strong idea of China restarting very quickly, very strong, that the world economy will be firing at all cylinders, that might be not the case. What about the year-to-date industries performances? If you think that the S&P is here, that gives you the dispersion between the winners and the losers. So if you have been starting the year with no net exposure means your long and your short will be very much the same, but actually you have been running a decent gross exposure or even an average gross exposure, the pain has been immense, has been really, really big for many hedge funds. So if you've been carrying the same position at 2022, where you've been really short all the dodgy names and long quality, what has been really January 2023 and the start of February is really dislocation and the reversion of last year. So, but in big terms. So that is in terms of standard deviation move, that is a really big move. If we look now at the week-to-date industry performances, that is the same picture, where actually you can see that some of the big winners of last year, the energy, has been underperforming. So if you think on I think it was on Thursday, XLE was down 2%, was in the meantime because of Meta on the day. communication was up 5%. So literally, even with no net exposure, just running some simple gross exposure, you could have been down 7 to 10% on the day. So you start the day talking to your boss and say, look, I'm fine because, I'm not carrying any net or long position, and then you end up the day being down. So really, Thursday has been a very painful for many people, and the pain trade so far has been the market moving higher. If you look now at the sector's performance on the year to date and on the week to date, that is the overall the picture. As I just said, energy down 6% and telco up 6%. So huge reversion, like one of those dislocation. It's not even a rotation because it has been ongoing for a month, but that's really the Armageddon for hedge funds. So there was another note, I think it was from Goldman Sachs, where hedge funds was like the outlier, the 1% buying back of their shorts and buying back of their futures. So extremely painful day and week for many people. What about the US 10 years and the 10 versus the 2? So on a week to date, not much of a move, but actually we went to 3.4% after the FOMC was pretty dovish. And then the NFP, the job and employment numbers, which were much higher than expected, put the market more in a hawkish mode. So we had a bit of a swings in the 10 years, both in Europe and in the US, between Thursday, where actually yields went down 20 bips in most European bonds, and like 5 to 10 bips in the US, then the reverse on Thursday. So the market it feels very much like we are close to the end of this big move, where you have more volatility than usual. So the intraday volatility has been on the move on Thursday and Friday. And as we're going to see later, let's jump immediately into that one. If you look at the VIX actually, despite the market being very strong on Thursday, on Friday, had an update. That doesn't mean that, for those of you who have done the 4x4 video series, you know that normally it will go inversely. But from time to time, if the moves are extreme, especially on the way up, don't be surprised to see the VIX going higher, because that means as well it could be distorted by, as we're going to see later, the calls, the massive calls that have been bought on the day. So if we look now at the euro dollar and what are the Fed expectations going forward, so the terminal rate is still the same. Okay, terminal rate is going to be around June of this year, so not much of a change. Now the question is, what about the September, December? And the market is oscillating between the Fed is dovish, the FOMC is dovish, so it's fine. We're not going to have much of 25 bips between now and June, and then they will have to cut because the economy is slowing, and then you have another number and it goes the other way around. So a bit of volatility, but as you can see from the red line here, which was last week, and the last, which was on Friday, everything has been coming lower. In other words, from one week to another, markets participants are expected a bit more hawkish Fed, which if you look about how the equity market has been doing, some stuff are not fitting the bill. So there are some issues between what is the price action and what is the understanding of what the FOMC could be and the Fed could be doing. If you look now at the price action through technical analysis, looking as always with the S&P, and if we look at the weekly chart, so something that we flagged, I mean many people flagged it, so it's not like it's going to be rocket science. So we broke this level. My view was it will be a bear trap, a bull trap, sorry, for the time being. it is not quite moving higher. We are going into levels that we had over the summer, so the 4,200 level is a big level. If you look at the Nasdaq, picture is the same. You know, if those candles are pretty strong so far, the Russell is the same. Emerging market is not. So China and the copper and oil are giving you a bit of a different picture. If you look at the stock 600, strong as well. So starting with the S&P, with the SPY, and for those of you who have been on the community, I've been clear that on Thursday I started to put a position as a put spread. June, it's a 4,100, 3,600, where you risk reward is 4-1, so pretty good. I'm thinking that now putting some exposure to the S&P it makes sense. As I've been saying a couple of weeks ago, I'm carrying some short exposure of Europe, sorry. So I'm down 2% on that position. Not the end of the world, but not really nice as well, because you would like to be perfect on the timing. But for those two positions that are on different books, that makes roughly 20% of the NAV short. One will be to the futures, and the other one will be delta adjusted. CL1. Really, the picture we have been trading, ranges, but actually that tells you that the risk on is not completely, and that's an understatement, validated by both the CL1 for this week and for the copper. So copper very weak over the last 5 days, over the last 5 sessions, and giving a lot back from what we've seen on the hope of the China reopening. To me, euro dollar, it's the most important chart and the most important catalyst for the next few weeks. Why? Because when the market goes into 4 to 5 weeks of big move, and actually a reversal of a move that you had for a year, where we had a year last year where Nasdaq was down 30%, we reversed this year. But what you're trying to identify is across asset classes, some assets that could be changing, where the trend could be turning. And that is something that we flagged on Thursday when the ECB, where after the FOMC meeting, actually we went to the 110 on the euro dollar. And since then we have been coming lower. So that's 2% move on the euro dollar over a couple of days is pretty significant. So that's really something that we'll have to do and to check in the next few days. The charts, the meta. So we flagged last week the 155 on the meta to go from 155 to almost 200 on the day was quite something. So I looked at the numbers. I'm still scratching my head. I understand that they're going to do a 40 billion share buyback. If you remember, they already did a 40 billion share buyback. That was a couple of years ago, and most of their share buyback was at 300. I understand that they're going to invest less in the metaverse. I understand as well that the PE could look like, let's say, attractive. But I understand as well that if you look at the next couple of quarters, there is no growth expected year on year, and everything for most of those stocks will be growth from H2. So market has been moving from, let's say, hard landing to a soft landing, and it feels even more like now the market is not even pricing a soft landing, that everything is going to be fine. My view is still the same, that if you look at most companies, if you look at especially this earnings season, it's pretty bad. So the fundamentals will have to come back. Google, same picture, breaking the downtrend, going into a very important level, as you can see, the 105. And then if you look at the FANG versus the SPY, so that will be Meta, Amazon, Apple, blah blah blah. We have been coming back into important levels that started from October onwards. Another chart that I would like to put, which is Amazon. So Amazon looks really ugly to me. I mean, this candle is really a bad one. If you look at the daily chart, that is one of the very few charts that actually had almost an island reversal. So some negative into stock picking. If you look at the overall picture, the indexes have been very, very strong. So that has been the story of this week. Coming into this week, what has been happening, as you know, we had the central bank, so we got the FOMC meeting on Wednesday. On Thursday, we got the ECB and the Bank of England. So Powell was pretty dovish, saying that, very much like what he started to say from November onwards, that the economy will be probably soft landing, that he sees that inflation is coming down. So the market loved it. And the ECB on Thursday, I listened to this poor laggard. I mean, it was an awful call. I don't know if she's because she's French like me and she's very, very bad like me, or she's just like, she sounds completely lost. Each time someone was asking a question, she was answering something different. So my view was, the more she was hesitating on the answers, the market loved it, meaning that she was close to, or the ECB was close of ending this hiking cycle. So you have very different messages between what the central banks are telling you on one end, that they want to be very strong against inflation, on the other hand that the market is more and more saying, if you look at here, this is the euro dollar, so that's on the 27th, that was last week, and from this one on Friday. So if you look at December, that tells you minus 10 bips. That tells you that the Fed is seen as being more hawkish. But in the meantime, price action and risk on has been the story of the week. What has been really important for these stocks and these moves up in stocks from 7:30 here, so that will be here on Wednesday, is very often when you come into those events, which is the same as if you want to be buying protection for on the day of the earnings for a company at the earnings date, what's going to happen is the volatility will be outbid, will be way higher. The implied volatility on the day will be much higher than a usual day. And let's say if you get the VIX, which is telling you that the volatility should be at 18-20%, on a day like the FOMC, on a day like the NFP, those implied volatility could be at 30%. Once the market sees that there is no reason to have such a stress around that day, suddenly the volatility get dampened. As the volatility get dampened, people have to be buying more exposure. They can increase their gross exposure, and you start to see the market rally. So that has been the story for the VIX, and against that you had the S&P that went that way. So that is very much what has been happening on Wednesday. Then on Thursday, complete dislocation, where when I say dislocation is not the right word, but for many hedge funds that were carrying positions, we had really a big move in terms of standard deviation, where the people get really squeezed. So if you look at the 5 days on the factors, the short interest factors went up 4% on the week, whereas on the other end of the spectrum, anything that was low risk, the low momentum factor, the long-term momentum factor, so everything that, as I said before, you start with the week with a gross exposure of 0 and say, okay, I'm going to be fine because it has been working well so far, then you get absolutely destroyed. So for those of you who have been the book, and I know for some of my mentees that has been the struggle before, is when there is a trend, suddenly your market goes, your portfolio goes really through the window because everything goes against you, despite not having any net exposure. It's just the growth kills you. And if you look at what has been happening on Thursday and the same on Friday, we are back to the zero debt to expiration, and a lot of frothy markets where all the dodgy names will be on the move. People are really strong and buying calls, so you got a strong activity in calls. So here, this is the total volume call on the NICE on the US market. So one picture is telling you that the earnings, so if you go back into fundamental, the earnings season so far has not been great at all. So if you look at the S&P 500, down 5% on the earnings. So really, if you want to believe that at one stage the fundamentals will come back, if earnings are not growing, that's going to be, and that should be a struggle for the S&P. So if you are bearish like me, and not extremely bearish, but if you get 20 to 50% net exposure, you want to believe that. If you are bullish, you will say that we reached the bottom in Q4 and now everything is going to be fine. So, and looking at the picture of the ISM, so ISM manufacturing is giving you the overall the same picture, which is the economy slowing and getting close to the recession. And the services are telling you that the December number could be a one-off and we are back to the levels that we had before. So very different numbers and very volatile numbers. The NFP numbers, so the unemployment numbers yesterday on Friday, was totally distorted by the way of doing the calculation. I'm not going to pretend to do how to do it. I know that there are some funny guys on Twitter that have been saying that they have been reached to do the new the way of calculating. I think it's quite funny and it's quite embarrassing. But that tells you and that after this number, the market thought, okay, good is such a good number. It might be a bit bad actually, because that means that the Fed will have to be more hawkish than what we thought a couple of days ago. So going into the catalyst, I think one of the one that will be very important is the Fed Powell on Tuesday, as we're going to see if he's going to double down or not of what he has been saying on Wednesday about the Fed more or less being dovish, and we're going to have a soft landing and inflation is coming down and it's going to be fine, or is going to be changing a bit the narrative. In terms of the macro numbers, there is not much. There is a bit of German inflation, the Canadian PMI. If you are looking at Europe, there is the Swedish rate decision on Thursday. Still, we're going to have some earnings, but most of the earnings, let's say 2/3, 70% of the earnings are in the rear mirror now. We only got 91 issues, 10% of the market value. So quieter market than before. I'm looking at two things. I'm looking at the FANG versus the SPY. So as I looked before, and it's very much not only the FANG, it's about looking at all so the FANG underperformed last year. We know that that was the first time in quite many years that they started to underperform. We know that January was very much about all the dodgy names, the meme stocks outperforming. So if you are looking at the turn in the market, that is some of the pockets of the market to be looking at. And I'm looking at the DXY. So looking at the DXY here, as you can see, that has been the trend recently, and it's only 2 days. So 2 days don't make a trend. But as a trader, you would like to try to identify when there is a turn. It feels very much to me like Thursday and Friday were the extreme, where people that were holding positions so far gave up. So you're gonna see at least probably not the same trends as before. I want to believe that based on what I see with the ISM, based on what I see from the companies looking in details into the earnings, I think now that it will have to catch up. So far, I've been more wrong than I'm right. So we had 4,200 on the S&P. I think we will have to come down now at least into the 3,900. So that's my view. If I look at the positioning that I'm holding, looking at the risk reward that you can have, a 4-to-1 with a 10 to 15% downside, I think this is great risk reward that you should be holding. On top of that, really, if you look into the earnings details, there is, for most companies, not a great earnings season. So that is my view for the week. If you have some questions, if you like to watch the video series, if you are interested in the mentoring, so mentoring Q2, so starting in the next in 2 months time, I'm starting to have new people coming. I'm gonna have some people from Asia and the US ending their mentoring. So if you are looking into education and learning through the mentoring you can start to contact me, because there will be some seats available. If you want to join the community, there is a channel that is free. I try to put some content, and there are some other channels that will be for 4x4 subscribers and for mentees, which are for more advanced education and more advanced knowledge. We try to share ideas and to share knowledge. So that is all for me. If you got any questions, please come back to me. And if you want me to discuss about a subject next week, please feel free to suggest and send me an email or put it in the community. Have a good week, and talk to you in a week. Bye-bye.